It's joining me now are Michael Gapen, Chief U.S. Economist at Morgan Stanley, and Anastasia Amoroso, Chief Investment Strategist for Private Wealth at Partners Group. Thank you both very much for being here. Michael, let's start with you, because we were just discussing with Steve that there's, expected to be some dissent over the quarter-point cut. Do you think that's more emblematic of the macro uncertainty that's out there, or just the fireworks and the politicization and all the various headlines we've seen in recent weeks?
Well, I don't think the economy justifies or warrants a 50 basis point cut, so I might argue that would be a little more maybe in the political realm. We've argued, I think, what Steve was just debating there, which is if the Fed, I think, is looking more to make a recalibration of their stance. They think risks to the outlook have shifted in the direction of a weaker labor market. And so restrictive policy isn't justified. So I do think the point here is they want to recalibrate, get closer to neutral. And in our view, that's at least 75 basis points in cuts, probably 100. And the weak August employment data alongside August inflation data, which showed relatively limited tariff pass-through, I think allows them to do consecutive moves here. So our argument is closer to, it's not fully baked and preordained, but it's closer to that. And I don't think the economy justifies a 50 basis point cut out of the gate.
Anastasia, you agree with that kind of more balanced approach, but kind of tilting toward that potential macro backdrop weakening?
I do. I think the economy does justify a series of rate cuts into the end of the year. And I say that looking at the labor market, I mean, the Fed cannot really deny that the labor market weakness is everywhere, and we don't want to risk for it to spread. Whether you look at the number of jobs that are created or the downward revisions or the lack of job creation in any sector outside of healthcare. So I think the Fed will want to preempt that. And to Mike's point and Steve's point is, the way to preempt that is to get back to neutral. So that's why I do expect to see 75 basis points of rate cuts into the end of the year. Obviously, if they do that, the time is of essence, and the time is now, because we are going through what I call the quarter of adjustment, which is companies are adjusting to higher tariff rates. How are they doing that? By absorbing some of the tariff expenses, but maybe not hiring as much. So that does weaken the labor market and the economy. And yet going into next year, we do expect the stimulus from tax cuts, but it's not here yet. So I think if the Fed is successful in delivering the cushioning, the stimulus that's needed today, we can see this expansion, modest expansion, continue into 2026. But it is contingent on them acting now.
Michael, you mentioned you don't really feel the economy right now warrants a half percentage point cut. So therefore, I assume that means you think it's kind of hanging in there okay. I'm wondering about the interplay between the labor data and, I guess, the rest of the economic indicators. If you go back several months, Chair Powell was leaning on the low unemployment rate to say, look, we don't really have to act to get closer to full employment. We're fine right here. We're going to wait and see. And now we got this weak run of labor data. And I'm wondering if that's more representative of the underlying trend, or if there's enough anomaly in there that we're getting the dovish move because the labor data is telling you to do it, but the rest of the economy is doing okay. How do we think about those things?
Yeah, I think there's some truth to both of what you said, which is they are worried about the employment data and the fact that it may point to downside risk, but the unemployment rate's low, the labor market's still relatively healthy and tight overall. The way that I would answer this is that the Fed, at least to my ear, is not saying policy needs to be loose or easy. They just think it needs to be less restrictive. So what that does is allow a better balance. They're in a better position to respond to that labor weakness if it emerges, or they can still stay around neutral if the unemployment rate stays low. So I think it's about getting to a position where they can react to how the economy evolves rather than sitting in a restrictive stance. So again, I think it is important to remember here, the Fed's not saying it needs to be easy. It's just wanting to go from a restrictive stance to a neutral one, and I agree with Anastasia. There's a window here, I think, to do that in relatively short order, and I think they can take the opportunity to do it.